We're looking at an analysis report on Beyond Meat, ticker BYND. The core argument is that its recent billion-dollar debt restructuring was a vital reset. It wiped out the immediate survival risk, creating what the analysis calls a deep value opportunity.
And it does a great job of that. It sets a really high-energy, contrarian tone. The theme, Stop Panicking, Beyond Meat's reset is exactly what we needed, is crystal clear. It nails that idea that the 2027 debt wall is gone, so the panic selling should be over.
Right. It translates this messy financial event into a very clean story. The bomb has been diffused.
Exactly. And that strength, that clear narrative, is the perfect starting point for us. Because if survival is established, the next question has to be about thriving.
That's the crux of any turnaround story, isn't it? The market acknowledges the company has time, but they don't know how that time will be used.
Precisely. So while the report brilliantly diagnoses the debt restructuring as the surgery the patient needed to survive, the material needs to more explicitly connect the newly purchased time, until 2030, to the specific operational changes required for long-term health.
I can see that. I see the weakness. The focus right now is so heavily weighted toward the balance sheet. The debt is gone, which is huge. But the analysis just says the company is a leaner machine and is cutting costs aggressively.
Right.
It's missing the detail on how this newfound stability really changes the path of profitability. The debt wall being gone gets you out of the grave, sure, but what gets you back on the path to growth?
That's it. Exactly. The argument is about survival right now, not thriving. And the operational narrative has to bridge that gap. We need to show that this move fundamentally altered management's focus from crisis mode to, opportunity mode.
So the suggestion then is to really strengthen that operational story. Show the significance of that, $131 million in cash on hand.
Yes.
And detail how pushing the deadline to 2030 actually changes the timeline for hitting those key milestones the market needs to see. How do we make the idea of time more concrete?
You have to quantify the relief. That $131 million in cash, it might have seemed tiny against $1 billion debt maturity.
Right, it looked like nothing.
But now, it looks like a pretty significant war chest. We have to show what the extended runway lets the company do strategically that it just couldn't do before.
Okay, give us an example. How does that reframe the whole narrative?
Well, instead of just saying cost cutting, the analysis could suggest that the new 2030 deadline lets management shift their focus to something critical, like long-term R&D. Maybe improving product taste or texture without that immediate pressure of liquidation hanging over their heads. Or, it lets them chase those big international partnerships that take forever to negotiate.
Because they know survival isn't depending on a deal closing next quarter.
Exactly. It shows strategic choice instead of desperation. And you mentioned quantification. That's where the rigor really comes in. It is. The analysis has the number $131 million. It would be so much more effective to show how much longer that cash is projected to last now that all those debt payments are gone. If their old cash burn was, say, $50 million a quarter, and a third of that was debt-related, getting rid of that basically triples your operating runway. That simple math directly links the balance sheet reset to the operational breathing room. It gives the deep value thesis serious teeth.
And that connects directly to what the market is going to expect from the next few quarterly reports.
Right.
If they know the runway is longer, they can forgive a quarter or two of slow progress, as long as that R&D story is compelling.
That's it. It changes the goal from be profitable now to show us you're on a clear path to profitability by 2030. That's a profound shift the analysis has to capture.
That makes the argument so much stronger. Okay, so now let's pivot to the cost of that survival. The material does a good job of flagging the elephant in the room.
The dilution.
The massive dilution.
Indeed. The report accurately addresses the massive dilution as a bitter pill and argues it is already priced in, but it really must better integrate the sheer magnitude of that share count explosion into the deep value setup.
Okay, so the core rhetorical tool in the report, comparing owning a diluted piece of a surviving company versus owning 100% of a dead one, is powerful. But you're saying it doesn't fully grapple with the permanent hurdle that dilution creates.
Precisely. The weakness here is that the analysis notes the share count exploded from, 77 million to over 450 million?
Yeah, a six-fold increase.
Right. And while that removes the bankruptcy risk, that six-fold increase just fundamentally changes the operational performance you need to generate any meaningful return for current shareholders. The current valuation argument, $1 a share, market cap under $500 million, it kind of overlooks how hard it is to generate earnings per share with that huge new denominator.
That is such a critical point. If the share count went up 6 times, the company needs 6 times the operational improvement, 6 times the revenue or savings just to get back to the same per-share metric as before.
And that drag is permanent.
Yeah.
That's the point that has to be driven home. So the suggestion is to make sure the analysis acknowledges this massive financial hurdle. And this doesn't weaken the argument, by the way.
No.
It strengthens the contrarian case because it shows a full understanding of the risk before showing how the company might, just might, overcome it. It gives the whole thing a lot more credibility.
So before we even get to the solution, let's just pause on that challenge. Isn't a 6-fold increase so structurally difficult to overcome that it almost forces this analysis into being more of a pure options play than a deep value thesis?
That is the essential question the analysis has to answer for the reader. It has to get out ahead of that. This is why it needs to shift focus, just for a moment, to the sheer scale of the required operational lift. The dilution means the path to traditional EPS growth is incredibly steep. The analysis has to show that the company's internal efforts are accelerating faster than the share count expanded.
Building on that, what if we try to quantify that dilution drag in terms of required sales?
Excellent path, yeah. For instance, the analysis could show what it would take to get back to a historical market multiple. It could lay out just how much more aggressive the cost-cutting or revenue growth has to be now compared to the pre-dilution world. You have to connect that massive denominator to the numerator.
And we should probably touch on the capital structure itself, beyond just the numbers. Like, who are these new shareholders?
That's vital context, yeah. The analysis could briefly touch on how the market might view this. I mean, the former debt holders who took equity, they now have a huge stake and an interest in long-term survival. That aligns their goals with existing shareholders. You've shifted them from a creditor to a partner, which is a subtle but powerful part of the turnaround story. It's a key reason why this dilution, while so painful, was actually necessary.
Okay, moving on to style. The material is very engaging. It delivers on that high-energy contrarian promise. But we do need to calibrate the tone a bit to make sure it feels rigorous and not just, promotional.
That's a great way to put it, a calibration. So, while the high-energy contrarian tone is effective, the reliance on highly speculative outcomes, like predicting that any good news could send this thing vertical, it sort of undermines the calculated nature of the deep value thesis that the report is otherwise building.
The weakness is pretty clear there. The analysis says survival risk is gone, price is at rock bottom, but then it uses this really aggressive binary language. Phrases like, dead, no, send this thing vertical. Selling is over. It all implies this rapid, guaranteed upside based on some external event, like a big McDonald's announcement.
Right, not on the inherent financial improvement we were just talking about.
Exactly. It risks making the whole thing sound more like a momentum trade than a genuine value proposition.
That makes perfect sense. If the thesis is deep value, then we're looking for a return based on intrinsic improvements, closing a valuation gap, not just a short squeeze triggered by luck. So the suggestion is to keep the bullish sentiment because the thesis is bullish, but ground the upside in probabilities and technicals that are based on internal performance.
We want the reader to feel like the thesis is protected by solid analysis, not just hope for a random catalyst.
Yes.
So how do we keep that excitement, the short squeeze potential, without just leaning on pure speculation? I mean, we have to acknowledge this stock is heavily shorted.
You absolutely do. The report should maintain its focus on the crowded short position, but reframe the upside. Tie that critical technical level, the $1 price floor, not to some speculative announcement, but directly to internal factors the company controls. This is where we can integrate our first and third critiques.
Okay, give me a concrete example of that connection.
So, for example, instead of focusing on a sudden explosive move, the analysis could suggest that watching that $1 level like a hawk is crucial because holding it establishes a new floor post-dilution.
Right.
Then, the report could link that technical floor to specific internal milestones. For instance, holding that price signals market confidence if management can hit a new cost efficiency metric, say, improve gross margins by 500 basis points, or if they maintain that $131 million in cash beyond Q3.
I see what you're doing. You're arguing that internal operational stability creates the environment where a short squeeze can happen. The squeeze isn't dependent on an external lottery ticket.
The execution is the catalyst.
The execution is the catalyst.
Exactly. That approach just elevates the whole discussion. It turns that technical floor into proof of management's ability to execute, regardless of whether a big partnership shows up tomorrow. And that shift in tone makes the analysis feel much more calculated and controlled, which is way more convincing for a serious investor.